Okay, we're going to work on some adjusting entries using the exercises in Openstax chapter 4 exercises at the end of chapter. And so I have a link to that website at the bottom of this screen. So it's just openstax.org. I'm just using them as supplemental exercises to try to get you some reps on these adjusting entries. All right, so the first one we'll do is exercise EA3. It says identify which type of adjustment is indicated by these transactions. You can choose accrued revenue, accrued expense, deferred revenue, or deferred expense. And so I just abbreviate those with the letters, AR for accrued revenue, etc. The first one, rent paid in advance for use of property. That would be a deferred expense. When you pay it in advance, it just means you can't show it as an expense yet. So you need to put it as an asset, as prepaid rent. And then cash received in advance for future services. That would be an unearned revenue, which you would call a deferred revenue, same thing. And then supplies inventory purchased. That would be also a deferred expense, because it's later going to turn into cost of goods sold, but for right now, it's a deferred expense, it's an asset. And then fees earned but not yet collected, that would be like accounts receivable. So that would be an accrued revenue. Okay, here's another set. If I were you, take a pause the video and answer the next ones. And then, oh, I'm sorry, it's not exactly the same kind. But what this one's doing is asking you which account is associated with them. So when you're making an adjusting entry, you're always going to be using one balance sheet account and one income statement account. It's not just some random account. It's the account, it's his partner account. It's the toggle account that if it's not salaries payable, then it must be salaries expense, right? And if it's not depreciation expense, the other part of the adjustment for estimate, the entry for that, the other side of that entry is going to be the accumulated depreciation, right? And then for supplies, when you're making an adjusting entry, you would have supplies the asset account and supplies the expense account, right? So supplies expense will be the opposite, the other half of the entry. And then unearned rent is a liability account. And so if it's not unearned, then it is earned or revenue, right? So rent revenue. Okay, now EA5, this is asking for some journal entries. Reviewing insurance policy revealed that a single policy was purchased on August 1st for 1 year's coverage in the amount of $6,000. There were no previous balances in the prepaid insurance account at that time. So based on that information, make the December 31st adjusting journal entry to bring the balances to correct and show the impact that these transactions had in a T account. So what we're going to do is we're going to do both of these. The beginning balance of prepaid was nothing and no balance at the beginning, but they said that we had paid a premium of $6,000. So prepaid insurance has $6,000 in it. It's a 1-year policy purchased on August 1st. So by the end of the year, you would have some of the insurance would have expired. So let's see, that's August, September, October, November, and December. 5 months have expired. August, September, October, November, and December. 5 months expired. So 5/12 of the 6,000 has expired, which means it should be shown now as expense. So we're going to do an entry to show 5 times 500. $6,000 for a year's policy means 500 each month. So the insurance expense entry would be $2,500 because it's 5 months at $500 a month. So we're shifting from prepaid insurance over to insurance expense, $2,500 of the cost. So when we post that to our T account for prepaid insurance, that leaves us with unexpired prepaid insurance of the remaining $3,500. And looking at it, that means there's 7 months left January through July left that's not expired yet, that should still remain in the prepaid insurance, right? So that makes sense, doesn't it? Okay, good. Now, EA7, this one says reviewing payroll records indicates that the employee's salaries that are due to be paid on January 3rd include $3,575 in wages for the last week of December. There's no previous balance in the salaries payable account. Based on that information, make the December 31st adjusting journal entry to bring the balances to correct. So if there's nothing in salaries payable right now, we need to record this full $35.75 as salaries payable. And so we'll show it as a debit to salaries expense and a credit to salaries payable. Okay, the next one, EA8. Supplies are purchased on July 1 to be used throughout the year in the amount of $8,500. On December 31st, a physical count revealed that the remaining supplies totaled $1,200. So that was the value of what was left. All the rest of them were used up during this period. So everything that's all of the 8,500, the excess over 1,200 of the 8,500 got used up. So it should be reported as an expense. There was no beginning balance in supplies. So they want you to create the journal entry for the first transaction, the original transaction, which is the purchase of the 8,500. That will be a debit to supplies and a credit to cash. Then they want you to create the journal entry for December 31st. So basically, we're going to post that beginning entry, that $8,500 debit to supplies. And then we want the ending entry for supplies to wind up being the correct amount, $1,200. So we want supplies to wind up being $1,200. How do we take an account that has a debit balance of $8,500 and bring it to the correct balance of a debit balance of $1,200? Can I put a negative debit balance in order to decrease it? Like I could just maybe put a negative on this side, put a negative 7,300. Would that work? No, you can't make negative journal entries. So there's only one thing left to do. If I want to take a debit balance from 8,500 down to 1,200, I have to credit the account. So I need an entry, excuse me, that debits, an entry that decreases the balance by crediting the supplies account for 7,300. So that's what I'm doing, making a journal entry for 7,300 because I need the T account to effect an ending balance of $1,200. The only way I can do that is to credit the account by 7,300. Okay. Now, they want us to prepare journal entries for these business transactions. On January 12th, we purchased supplies for cash for $3,850. So again, debit supplies, credit cash. Then on December 31st, they counted up the supplies and it equals 800. So it's just like the problem we just did. It's just that it's not weighting us through the T account. So on the margin, you could just make a T account. You can impress me on a test by answering a question with a T account that depicts how you figured it out. So you just make your T. You would debit $3,850 to supplies, and then your ending balance would be $800. You're trying to adjust your balance to correct. So in order to take a $3,850 debit balance down to an $800 debit balance, you have to credit supplies. You're going to use this little partner account, supplies expense, to toggle $3,050 out of supplies the asset into supplies the expense. Because if it's not still sitting in supplies the asset, it's not sitting in the supply closet, that means it got used up. So it should be reported as supplies expense. Okay. Now this one, this is EA10, and it wants us to prepare journal entries regarding this insurance. Insurance that expired this period was $18,000. Now there's two ways they could tell you. They could tell you how much the supplies too, but insurance, specifically this time, they could tell you how much insurance was paid and then how much still remained unexpired at the end of the period, or they could just say how much expired. If they say how much expired, then you know that that's the amount you're going to put as a debit to insurance expense. So debiting insurance expense, $18,000 means Its partner account is what gets credited in the adjustments. Prepaid insurance. Adjustments always have a balance sheet count and an income statement account because it's just a toggle between the two statements. Is it time to report this on the income statement yet? If it's not, leave it on the balance sheet. But if it's time to report it on the income statement, you shift it with a journal entry that moves part of the cost or part of the revenue to the balance sheet, to the income statement account so that you can true up your balance sheet balances. So in this case, we had to show that part of the prepaid insurance had expired. So that means it was coming out of prepaid and going into insurance expense. Prepaid is an asset. So if you decrease that balance, it means you're crediting it, right? So this journal entry is saying insurance expense increased and prepaid insurance decreased, right? Now then depreciation on assets, easy money entry. All you do for prepaid asset, for depreciation expense is just debit the expense, credit accumulated. They give you the amount. Then salaries earned by employees but unpaid, $1,200. That's also very easy entry, debiting the expense, crediting the payable. PA1, this one wants us to identify whether each of the following related to revenue recognition or an accrual, deferral, or neither. So if you earn income now and you collect it now, is that a deferral, an accrual, or neither? I say neither. If you earn it now and collect it now, that means no matter if you use cash account, a cash method or accrual method, it's still time to recognize the revenue, right? What if you earn it now, but you collect it later? Is that an accrual or is that a deferral? What do you say? That's an accrual because the money hasn't moved, but it's time to recognize the revenue. What if you earn it later, but you collect it now? The money has moved here. So that means it's a deferral. We're going to defer recognition about that item. All right. Identify which type of adjustment is indicated by these transactions. You could choose accrued revenue, accrued expense, deferred revenue, or deferred expense, or E for estimate. All right, so utilities owed but not yet paid. That would be an accrued expense. Cash received in advance for future services. That would be like unearned revenue. So that's deferred revenue, isn't it? C, supplies inventory purchase. This is going to be an expense one day, but right now it's a deferred expense, isn't it? D, fees earned but not yet collected. We're going to record it as revenue, but we don't have our money yet. So that is accrued revenue. What about depreciation expense recorded? That's not accrued or deferred. That's estimate. And then insurance paid for future period. That's a prepaid insurance, which is a deferred expense. It's going to wind up being insurance expense one day, but right now it's for a future period, so it's a deferred expense. All right, now here's one about the expenses. So these are transactions regarding, it says revenue recognition, but it really is about expense recognition, accrual, deferral, or neither. If you have an expense now that you pay now, that's neither an accrual nor a deferral. And if you have an expense later that you pay now, the cash already moved, then that is going to be a deferral, deferred expense like prepaid insurance or supplies. Expense now and pay it later, that's an accrued expense. Okay. Now this one, identify which type of adjustment is indicated by these transactions. Again, this is the same one we did earlier, accrued revenue, accrued expense, deferred revenue, or deferred expense. You could pause and do this one and then come back and see if it's right. Okay, fees earned and billed, but not collected. The money has not moved, but we earned the money. So it's accrued revenue. Recorded depreciation expense. That's an estimate. And then the next one, fees collected in advance. That's a deferred revenue. And then salaries owed but not yet paid. That's accrued expense. Property rental cost, prepaid for future months, prepaid expense, which is a deferred expense. And then inventory purchase for cash, that is a deferred expense also. Prepaid asset, prepaid expense is going to turn into cost of goods sold eventually. So it just would be the inventory account. Okay, and then this last one, this is asking us to, again, to identify whether it's accrued revenue, accrued expense, deferred revenue, or deferred expense. And so I'm going to give you a minute to see if you can answer this for it. It wants to know which type of adjustment, and then if it's which kind of is accrued revenue, accrued expense, deferred revenue, or deferred expense. Okay, so salaries payable. This one is accrued expense, and its partner account, the account that's associated with it, is salary expense. And then the second one is interest receivable. It's an accrued revenue, interest revenue. The third one is unearned fee revenue, and it is a deferred revenue. Its partner account is fee revenue, or fees earned. Then prepaid rent, it is a deferred expense, and its partner account is rent expense. So these were taken from the Openstax chapter 3. And I'm thinking that those might have been from Openstax chapter 4. But anyway, so these were taken from chapter 4. And so we'll just leave it at that for this time.